We always think of, the typical repercussions of misclassification of independent contractors, like unpaid overtime or unemployment insurance and workers' comp contributions.
Yeah.
But this is another one where, you could unknowingly be subject to ACA penalties for not offering coverage where, you have a large independent contractor population.
Welcome to Mission to Grow, the small business guide to cash, compliance, and the war for talent. I'm your host, Mike Vannoy. Each week, we'll bring you experts in accounting, finance, human resources, benefits, employment law, and more. You'll learn ways to access capital through creative financing and tax strategies, tactical information you need to stay compliant with ever-changing employment laws, and people strategies you need to win the war for talent. Mission to Grow is sponsored by Assure. Assure helps more than 100,000 businesses get access to capital, stay compliant, and develop the talent they need to grow. Enjoy the show.
The Affordable Care Act, rules, records, and repercussions. So this is an important topic for small businesses that are especially growing. When you start out as a really small employer, maybe your first employee, your first 10, 15, 20 employees, this isn't something that you necessarily had to comply with. You probably have heard about the Affordable Care Act, passed in 2010, sometimes called Obamacare. And for you, that was always the thing about larger businesses. But businesses who are growing, you've got to understand, because there's legal requirements, and these legal requirements have teeth. As soon as you cross over a certain threshold, we're going to break down what that threshold is, and everything else small growing businesses need to understand about the Affordable Care Act. My guest today, if you're a regular watcher of the show, you know who this is. He's got extensive experience defending class and collective action lawsuits under federal, state, and wage and hour laws. His practice focuses on representing employers in a wide range of workplace matters, as well as preventative advice and counseling. He has successfully defended wage and hour audits conducted by the U.S. and New York State Departments of Labor, and he regularly handles cases before courts and administrative agencies involving claims of discrimination, sexual harassment, and retaliation. Welcome back to the show, Principal at Jackson Lewis, Brian Shenker.
Thanks for having me, Mike.
All right, Brian, from the top, what's the number one thing small growing businesses need to understand about the Affordable Care Act?
Yeah, so I think that, the biggest thing, as you really mentioned in your opening, is to determine whether they're subject to this law, right? Because, especially for growing businesses that, may, grow in size, this year versus last year, there can be huge repercussions if you cross that threshold. And you shouldn't be surprised, when you do. There should be planning in place, because, compliance with, ACA is not something that happens overnight, right? It's something that you need to plan for. It's definitely doable. It's not overly complicated in some regards, but planning has to go into it. So understanding, what employers are subject to it is certainly a big thing. And then once you are subject to it, understanding, who you need to offer coverage to, all very important things. And I think, look, for even those companies, viewing this today that, are not large employers and applicable large employers, and we'll discuss what that is. Right. You should still be paying attention to this, obviously, for the first reason that you might one day grow and become a large employer, but also there are reasons that companies may want to offer health insurance and other types of medical coverage to their employees, even if they are a smaller employer. And so understanding what potentially your competitors who are large employers are offering is a good starting point for analyzing, whether that's something your company might want to do on a voluntary basis.
Right. Hey, Brian, let's maybe just start with a definition. I mean, this isn't a new law by this point. We're 14 plus 14 years in to this thing. We're going to call it by its name, the Affordable Care Act. Some people call it Obamacare in admiration. for the man in the process that led to the law and the I'd say truly, whether you think it's great or you hate it, groundbreaking. It was a tipping point for a country. But there are folks who use it in the affirmative. There also use the name in a pejorative sense. So we're going to call it the Affordable Care Act. Our mission here today is not to give our opinions whether we like it or don't like it. The reality is it's the law and you got to comply with it. So our job is to unpack what it means for small businesses. So let's just start with the definition of the Affordable Care Act. What the heck is it, Brian?
Right. No. So what the Affordable Care Act does is it imposes penalties on certain applicable large employers if they do not offer health coverage that meets certain minimum value and affordability standards to a certain amount of their employees. So really, what this means is that the law, the Affordable Care Act does not require large employers to provide health insurance, right? There's that term pay or play, which we've all often heard, which really means if you're not going to provide coverage and you're required to, then you're going to pay penalties, and they could be very costly. So what we really need to remember then is that ALEs, which I'll call them ALEs, that's applicable large employers, and those are companies with 50 or more full-time employees and equivalents. We'll break all that down soon enough. That they need to offer health coverage that meets certain standards to at least 95% of their full-time employees. If not, there are penalties. And so that's, in a nutshell, the setup, right? It's a little more complicated than that, and we'll get into it, right? There are, certain requirements for what the health plans need to meet, what they need to cover, the cost to the employees, because this was all part of these big changes to the law to health coverage in this nation, where the goal of the Affordable Care Act is to get more people covered by health insurance and to decrease those costs for the employees. So that's what we, really see. So I think today, much of our focus, at least at the beginning, we'll talk about how do you determine if you're an ALE.
So bottom line, the Affordable Care Act says if you're an employer of a certain size, an ALE, that's a legal term, applicable large employer, so ALE we will call it. If you are an ALE, then you've got to offer health insurance to your employees, or you got to pay a penalty. So I suspect there's not a lot of folks paying penalties intentionally as a choice, as an alternative to providing health insurance. But that's it in a nutshell. So that's now we're done with the easy part of this, right? So let's maybe, and that's who must comply. So all employers who are considered by law applicable large employers. You mentioned 50 plus full-time equivalent employees. Help us unpack that and whatever other requirements there are to be an ALE.
Right. So this is the big part of it. You need to have, and when we say, full-time employees and full-time equivalents, the ACA has a special way of, defining, who's a full-time versus, who's not a full-time individual. So, just remember, if you're an employer and you're saying, I've got less than 50 full-time employees, that doesn't mean you're not subject to this, because our part-time employees are counted too. And so really what we use to measure, full-time employees and their equivalents, we use this thing called the monthly measurement method, right? So we're going to, take a look back on a monthly basis over the prior calendar year to determine, each month what number of full-time employees and equivalents the company had. And we're going to take an average of that to see if the average for the prior year is more or less than 50. Now, there's a lot we need to break down because it's not as maybe simple as that sounds. The first question is, what hours are we counting, right? At what hours of service are we counting in determining what an employee works? So for hourly employees, right, that would typically be our non-exempt employees. That's a pretty easy calculation. It's going to be the actual hours of paid service, right? That's what must be used. So you're going to go back and look for the past year on a monthly basis. What hours they were compensated for. It's a little different, obviously, for our non-hourly employees, right? So these are going to be typically a lot of your exempt employees who might be salaried. And we might, as a company, you typically would not track the hours worked by those employees. So what the Affordable Care Act does is it gives us a few options, right? You can use the actual hours of service for those non-hourly employees, if perhaps your company tracks that. If they don't, then there are two different assumptions you can use. One is a day's worked equivalency, right? Where any day worked, we're assuming they, if they worked at least 1 hour, we're going to credit them for 8 hours worked that day, and we'll add it up that way. Alternatively, you can do a week's worked approach, where in any week in which the employee performed at least an hour of service, you're going to credit that non-hourly employee for 40-hour work week. So that's the way we're going to first, figure out the number of hours. And so, again, this count is very, very important, as you mentioned, Mike, because we want to make sure, especially for growing employees, right? You may have been, around 40, 45, in a past year, and you need to know exactly when you're going to be covered by these regulations.
So there's going to be two. We'll say there's three groups here. There's small employers who are, safely in bounds. They're under, let's call it 30, 40 employees, exempt and not exempt. And that's not changing anytime soon. This doesn't apply to you, right? And there's clearly those larger employers that you already know that you're well over 50 employees through either combo, exempt or not exempt. It's the folks that are in this, I'll call it the gray area. It's quite black and white by the law, but I think most business owners would see it as grayer. They're not sure, and I'd say especially firms that are in transition, probably not so much larger firms that are shrinking in employees because they would have already had to comply. They'll be familiar with the law probably, but smaller businesses that are growing, they need to plan and prepare for this. So let's get into some more of the specifics around how this monthly measurement works.
Yeah.
So if I think it's probably easier if we stick with exempt employees first. So because hourly you just calculate hours, but if I'm a growing professional services firm, I don't have hourly employees. Everybody's on salary. If I have 51 people fully employed for the month, no brainer. I'm an ALE, applicable large employer. I must comply. What about if you give me some use cases where I'm maybe on the edge? Maybe my plan is to be at 52 or 3 employees, but I've got turnover, and so somebody left on day 3 of the month, and I don't backfill them until day 27 of the month. How does all this math work?
Yeah. So, great question. And that's where then we're going to take, the averages. So, we talked about figuring out the hours worked, right? So we know how we're going to calculate that for hourly versus non-hourly. And so now, right, we have to keep in mind, so what the Affordable Care Act tells us is that full-time employees are those who work at least 30 hours in a given month, and anyone other than that goes into the full-time equivalents, right? So, right, it's very easy then to determine, how many, full-time employees you have. And it's often the full-time equivalent. So for instance, I could be a business owner with 55 employees, right? But maybe only 35 or 40 of them are full times, and then the others are full-time equivalents, and we're going to have to do a calculation. So that calculation is really as follows. So as I mentioned before, right, the easiest part is counting our full-time employees who work over 30 hours a week, right? Or 30 hours per week, correct. So what the ACA says then is that anyone who works at least 130 hours a month is full-time. So essentially anyone who works 30 hours a week or more is in that category. So you first count up all those full-time employees for each month for the prior calendar year. So right, we're in 2024 now, you'd go back to 2023, all 12 months, count up how many of those full-time employees you have at 30 plus hours a week. Then you have to do the full-time equivalents, right? So again, you're going back to the previous calendar year, and for each calendar month, you're going to add up all of these service hours for the non-full-time employees, right? So these can be salaried, hourly, whatever they are, but we're adding up all their service hours for each month. And now the one thing we're going to do is cap it at 120 hours. So even if we have one of these, non-full-time employees who may work, 125 hours in a particular month, when we're calculating this, we're only crediting them up to 120 hours. And then what we do, we add, all of these service hours for all the non-full-time employees, and we then divide that by 120. And that will give us our full-time equivalents, right? So, obviously, two equivalent to, part-time employees, could sometimes equal one full-time employee, but it really depends in this calculation on the number of hours, they work, the average number of hours worked each month.
Brian, am I right saying this is the place where people get in trouble because they think they count human beings? And so, this person is a 20-hour work week person. This person is a 35-hour a week person, or say a 40-hour a week person. And so I have one FTE, but the reality is I have 40 hours plus 20 hours, that's 60. That works out to 30 a week. I have 2 FTEs, right?
Right. So, and this is a big difference between the Affordable Care Act and most other employment statutes that we look at, right? Almost everything we deal with, a person is a person, right? An employee is an employee, right? When we're talking about, the number of employees needed to be subject to, Title VII, right? It's not
COBRA, more than 20 human beings working for you, you're going to have to provide COBRA, right? But this has got a different calculation.
Exactly. And so you're absolutely right. We need to look at them less as the individual, more as let's look at the hours and what does that mean, right? So, and that's really what this calculation is about. So, once you've, added up your, your full-time employees, you've calculated your full-time, equivalents, hours, and divided those, by 120, then whatever those two figures are, you add those together and you divide by 12 to get your monthly average for the prior year. And simply put, if that result is over 50, your company is an applicable large employer for this year. And if it's under 50, then you are a small employer, not subject to the pay or play requirements of the law.
So interesting, and I know where you're going to go with this, but in the downstream. But you said for the prior year. So why is it important that you're calculating this based on the prior year?
Right. So that essentially that's what the Affordable Care Act tells us, right? That when we're making this determination of whether your company is covered, that we're looking at the previous calendar year and taking those averages, right? It's not about, what we expect will happen this year, right? It's not whether, but January of 2024, we, laid off some employees, so we're under 50 now. That's not the question, right? It's about what occurred in the prior year, which determines whether your company will be subject to ACA for the current year. So very important to remember that, and that you can't look at necessarily changes that occurred in the current year as impacting your ALE status or not, for the prior year.
Okay. Anything else around determining if you are an ALE? So you talked about the hourly, aka exempt. You could talk about the hourly, the non-exempt, the salary, the exempt folks, how those calculations work, and it's based on hours, not bodies, right? To determine. You simply follow the formula, and either is binary. You either are or not an ALE, applicable large employer. If you are, then you must comply. Anything else going into that? Is there anything about industry?
So I think a couple things. So industry is a good one, right? So there is one exception to all this stuff we've discussed, which is in counting employees, which is applicable to seasonal workers. And so, this, when I say seasonal, right, that doesn't just mean maybe, a summer camp, but seasonal could very well be retail industry, right? Where, you're in retail and, you hire, a bunch of employees for, the holiday season in December for a month or two, right? So there's an exception that basically says that if the workforce exceeds 50 full-time employees for only 120 days or fewer, and those people in excess of 50 were those seasonal workers, right? And seasonal workers, they're just going to be working for 120 days or less, then we're not counting those in terms of becoming an ALE. So again, if you have employees that are hired for 120 days or less, it is possible they could be seasonal workers and they wouldn't necessarily count towards the calculation of whether or not your company is large.
Brian, would that be true regardless of how many employees? So so obviously you have a 6 to 8 week holiday shopping season from say mid-November through the first, January 1st. You have more extreme cases. I'm literally thinking, so maybe it's not so extreme, but a pop-up Halloween store might be a 4 or 5 week season. You could have a fireworks stand that may have 0 employees. Maybe you're self-employed year round, and for 3 weeks you might have a big staff. Does it matter how many employees you have during that seasonal period?
Right. Doesn't matter the industry, right? That can apply, in any of those circumstances.
What about in agriculture where your seasonality might happen a couple times? I might have a spring planting and a fall harvest. So I have spikes. As long as those employees are within the 120-day window. What about the time between?
Right. So it's really it's going to be key that, in total, we're talking about 120 days, right? You can't have, 2 120-day periods, throughout the year. That'd be too much. And then the key, right, is that in between, the time period when you don't have these seasonal workers, that you're under 50, right? So if you're hitting 50 in the months when you're still, when you're not employing those seasonal workers, then you're subject.
That's a no-brainer. Right. But let's just say it's an agricultural-based business. You got 10 employees year-round, but you spike up to over 50 for the month of April, and you spike up over 50 for the month of August, September during a harvest. you could have 2 seasons and still not be considered an ALE.
Right. As long as that's still within, the 120-day window that ACCA provides for this exception. And then look, I think one last point I would make on this employee count, and Mike, I feel like this is something that somehow we mention in almost every topic we discuss, is that if your company is misclassifying employees as independent contractors, that could have an enormous impact on your compliance with the Affordable Care Act.
Yeah, you know what? You and I have done it. Mary Simmons and I have done this topic. We got a bunch of content. If you don't know what we're talking about, go watch a show on classification, exempt versus non-exempt. There's no such thing as a legal classification as hourly versus salary. Those aren't legal constructs. There are requirements if someone is exempt from overtime or not, and you got to be compliant there. Yeah. So safe to say we're talking about W-2 employees, not 1099 contractors.
Right, exactly. And so, look, if your company has a good number of 1099 independent contractors, and it would potentially be enough to put you over that threshold to become an ALE, then I would suggest that you take a look, that you audit your independent contractors to make sure you've classified them correctly, right? We always think of, the typical repercussions of misclassification of independent contractors, like unpaid overtime or unemployment insurance and workers' comp contributions.
Yeah.
But this is another one where, you could unknowingly be subject to ACCA penalties for not offering coverage, where you have a large independent contractor population that would put you over, if they're misclassified.
Yeah, right. Okay, very good. I want to come back to, so now I've determined I'm an ALE, and now we have to determine what kind of benefits we offer, what kind of benefits and to whom we offer those benefits. But I'm going to skip ahead for just a second. What are the reporting requirements? Because I'm going back to your comment about prior year. So I have to calculate it for the prior year. What do I now have to do as an ALE to make sure that I'm compliant with the law?
Right. So there's certainly various reporting requirements, and those are going to be separate from the actual provision of health coverage. But let's go through those. So we're mainly looking at this form called the 1095C, and that form essentially all ALEs, all large employers under ACCA that are required to provide coverage, are required to complete 2 forms, this 1095C and I believe a 1094C. And these forms indicate to the IRS whether the company has offered qualifying coverage to its employees. And these are the forms that are going to be the basis of whether the company gets penalized for non-compliance with the law.
Yep.
So these forms are going to show who is offered coverage, who waived it, and so it's important to file these. There are filing deadlines. Missing the filing deadline can result in a penalty. Not filing at all is will certainly subject a company to a penalty. And so it's definitely important to understand that if you're providing health insurance coverage, that you're going to have reporting requirements. And this goes also for small employers who provide health insurance, right? There are also going to be reporting requirements, for small employers, such as, the value of the plan, on tax forms, things like that.
Without getting into all of the details of the tax return, tax form, maybe first, timing. Does this get filed with the annual income tax return of the business, I mean, as employers, we think 941 quarterly returns. What's the timing on this?
Yes. So interestingly enough, right. So it's different. I believe the deadline for filing the 1095 form is the end of February of each year. And so I think the IRS may have moved that into March now. Since it went electronically, so I believe now if you're filing electronically, there's an end date at the end of it would be March 31st. To get these things filed.
I think that's right, and I think the important, and I'll ask the producers here to make sure we include that in the show notes, please. So everybody gets the right information. I think the point that we want everybody to understand: this is not get stapled to your quarterly 941. This doesn't get stapled to your income tax return on April 15th. This is a separate documents, the 1095C, 1094C. These are separate IRS documents that have their own filing requirements and filing dates that are annual, right?
Exactly. And what I would also mention is there are not many states, but there are still a couple, maybe a handful of states that may require a separate state filing. So it's important to know, I believe, California is one of those. Washington, D.C. might still be one. Massachusetts, and there may be one or two others. So, just be sure, because at this point, right, when you have to file, you've already done the hard work, right? You ensured you provided coverage to everyone, and now you just need to get it right and report that so that you're not subject to any penalties for compliance that you've already done.
Now, to have the ability to do it, the forms, I want to say, I'll give my unqualified. I'm not a CPA. I'll say it conceptually, they're relatively straightforward. Just like any tax form, they're used to filling out. Put the dollar, put an amount in line A, add the line B, subtract line C, and if line D is greater than A, then here's your number. It's that kind of fairly straightforward logic, but the record keeping required to actually do the calculation to all this hourly calc that we talked about earlier here, that's probably the much more complex component. Would you agree?
Right. It's the compliance that comes before doing that, right? Having thought through a way that you're going to comply with ACA, right? That's what allows you to be able to file these tax reforms so easily, right? Yeah. It's not something that's pulled out of thin air. It's based on your substantial records of who you've offered to, who's waived coverage, value of coverage. It's very simple things if you've complied and gotten yourself that far.
Yeah. All right. So we might come back to that because you're reminding me of other things in the tax form about who's accepted versus you've offered, et cetera. This isn't just, hey, tell me how many people are in your org. Were you required to comply or not? So going back, we talked about the basics, what ACA is, who must comply. It's those who are considered ALEs, applicable large employers. Kind of walk through the math of that. It's the basically the hours worked calculation average, the monthly average. Let's move to, once you're considered an ALE, who must you offer these benefits to, and what are the requirements within those plans?
Yeah, great question. So I'll start out with the overarching requirement, which is, right, as an applicable large employer, you'll be required, to comply with the employer mandate, right, which is offering health insurance to at least 95% of your full-time employees. That's both affordable and provides minimum value, right? So we can get to the, affordable and minimum value. Those, there are a lot of requirements there. With respect to minimum value, often, your broker can assist you in finding those correct plans. Affordable, we'll get to that, but Right. The question is, now that you're an ALE, which employees are you offering, coverage to, right? And that's very important because, what we have discussed are, the amounts of the penalties, but there are penalties, right? If you don't offer coverage to everyone. And so you certainly need to then figure out, who these employees are. And so I'd like to just, go through that real quick because it can be somewhat of a different calculation than what we previously discussed in terms of figuring out if you are an applicable large employer. So just going through that, there are two different methods that can be used for determining which are your full-time employees, right? So we need to figure out now that you're an ALE, who are our full-time employees that we're offering this to, right? So these are going to be only employees who are full-time based on, the 30-hour per work week threshold. And so, employers can use two different methods for doing this. And really, as I'll explain, is there's really only one method that you'll actually use because one method is not realistic at all. So, one method that you can do this for is the monthly measurement period, right? So similar to what we were discussing earlier, right? You look at average hours worked, average hours of service worked each month to determine if they should be offered health coverage for that month, right? If they've worked over 130 in an applicable month, then they would be a full-time employee for that month. Now, using that method, right, because this is not looking back as we were talking about before, this would be looking at, if we're in, April, then we're going to look at the hours this employee worked in April. And everyone, listening right now is probably, asking the same question. Well, early in the month in April, when I have to, pay, health insurance premiums and, tell the health, insurance company who's covered for this month, how am I going to make that determination if I haven't seen the hours worked by this employee that month? And that's exactly why the monthly measurement period is more used to audit and look back at things than as a tool to determine who we're going to offer the health coverage for. So the way we're going to do, offer health coverage then is by using what's called the look back method. Okay. And so the look back method is somewhat similar to what we discussed before, right? We're not going to go back and look at a full calendar year. There's a slightly different thing we're going to do here. So first we need to figure out a stability period, right? And that can be anywhere, I believe, from a 3 to 12 month period where that's a period we're going to look back at and see, is this employee on average hitting 30 hours per week or more, during this measurement period, right? And so once so we're going to have a uniform, measurement period for all employees, right? So that can be 3 months, 12 months, right? You can set that up as you determine, right? There's obviously, a measurement period that's too small could be impacted by, hey, we've measured the busy season, right? And so, everyone's working more hours. So we have a lot more full-time employees than we really might have if we used, an 8-month measurement period or a 12-month measurement period.
Yeah.
So, based on your company's realities, you can look into, what measurement period would be the best, for determining full-time employees. And, I'll just mention we can have different measurement periods, but they've got to be broken down, for employees. But, the difference could be, salaried versus hourly. Employees in, different states can be treated differently with measurement periods, or, non-union versus union employees. But those are really the only, differences. Other than that, we're really treating everyone the same.
Brian, forgive me if I step out. I'm just trying to do some math in my head because I'd forgotten some of this. I'm really glad we're having this conversation. So there's a big difference in the determinations. The concept is the same, but it's falsely commingled here, right?
Right.
I think I was doing this coming into our conversation that I had forgotten. There's the hourly calculation of FTEs to determine if you're an ALE, applicable large employer. That's different than the FTE calculation of whom you now must supply the benefits, right? So
Right.
Tell me if my math is right here. If I can see myself as a small employer. I've got 10 full-time salaried people that kind of run the core business, and maybe I have 100 part-time workers that work on average 20 hours a week. And so in my mind, I've got 100 part-timers that 20 hours a week. That's not ACA stuff. They're not 30-hour FTEs. I've just got 10 people, so I don't have to. I'm not an ALE. But if I have 100 people that work, 100 people working 20 hours a week, that's 2,000. Well, I'll do the math. 100 employees times 20 hours a week times 52 weeks a year divided by 12 months. That's 8,666 hours divided by my 120-hour rule. I would have 72 FTEs. So first of all, I am an ALE in that scenario, right?
Right.
Okay. And so, yes, I'm an ALE, but whom I must provide benefits to, now those 100 people, I don't have to provide benefits to them because they are less than 30 hours a week. But I do have to provide benefits, at least offer benefits to the 10 quote unquote full-time exempt people I have, right?
Right. And so, right, when we go back and do this measurement for determination of who we're going to offer coverage to, right? I mean, if our only full-time employees, our only people working 30 plus, hours more per week are, exempt salaried people, it's very simple, right? It's not going to be complicated at all, right? But when, using this look back method, if we have, hourly employees who are, sometimes working, 30 hours a week, sometimes working 40, sometimes working 20, right? This is really designed to capture our people who might have variable hours, and it gives us a calculation to determine, all right, that employee who works, between say 25 to 35 hours a week, is that person going to be considered a full-time employee and someone we need to, provide coverage to? And so, right. So then, we have that, measurement period. So under this, a look back method, we have a measurement period. Let's say we have a 6-month measurement period. Then we're going to have essentially, most likely, an equal amount of time for the stability period. So we measure their hours for those 6 months, right? And now, so we've looked back at those 6 months for this, hourly employee whose hours fluctuate. All right, now we've determined, they average, let's say 32 hours a month. So, okay, so now they are a full-time. So then we had the 6-month measurement period. Now that's immediately followed by a 6-month stability period. So for those 6 months, that employee is going to then be considered a full-time employee, and they will need to get be offered health insurance coverage for those 6 months. Now, on the flip side, if that same employee, let's say the average came out to 28 hours a week, then we're now, or less than 130 hours a month, now this person is not a full-time employee, but only for that stability period. So we measured the 6-month measurement period, and now for that associated stability period, they will be considered to not be a full-time employee. And it's important to remember this because even if their hours change, right? So even let's say we calculated it that they fall below the 130 hours, so they're not a full-time employee. Then during that 6-month stability period, right? They may be working over 130 hours every single one of those months, but because that is the stability period and the previous measurement period, they were not a full-time employee. What they work during the stability period doesn't matter, right? They maintain their status as a non-full-time employee for that entire stability period. Once that stability period ends, right, then we do another measurement period, another stability period, and this just kind of goes on and on like this, where you continually measure. And so, the benefit of doing longer periods, right, up to 12 months could mean, once you take the measurement, you have a stability period of 12 months that you don't need to change anything, right? Which, as we went through, that could be good or bad, right? Because the measurement could make them a full-time employee for the next 12 months. Now you have to offer them coverage, right?
I'm going to ask this. This gets to be a deep ocean really, really fast on the calculation of whom we must offer benefits to. In your practice, where do employers get in trouble more frequently? Is it they know they're an ALE, but they don't offer it to the right people, or they thought they weren't an ALE and it turns out they are? Which of those two buckets do people get in the most trouble?
Yeah, so I think now that enough time has passed since this all took effect, I think more of what I actually see is employers, they understand they're an ALE, but they make mistakes in possibly not offering to everyone they should have.
Sure.
Right, and I think a common one is just thinking that you're going to offer only to your salaried employees, and then we forget about those non-exempt hourly employees that might actually be considered full-time because of the hours they work.
I guess that makes sense. At first I was thinking, based on just complexity of the concepts, it'd be the other way around, but once they've determined, and so maybe it's these companies that are in transition, they're growing, and so they're newly aware, or they should have been aware and now become aware that there's some folks on the bubble there. But once you are an ALE, now it's probably about improperly applying the law in an attempt to contain cost, right?
Yes.
But that you're some inhumane capitalist pig, but offering benefits costs a lot of money, and you're trying to control cost. And so you think, I'm just going to give it to this pool of employees, exclude this pool. And turns out the law may require you to offer it to some of those folks unwittingly, right?
Yeah, Mike. Yeah, exactly. And I think the real interesting thing is that, if you do these analyses, and like we said, there's some flexibility that employers have here, right? When determining, right, you can determine the measurement period here, and that could impact who you might need to offer coverage to. So there is room to make decisions like that. And that's why, good planning and looking at the method you're going to use, and how long is that measurement period. And look, for almost every business, the answer is going to be different because the realities of each type of business will dictate, right, what measurement period we'll use, right? So
right.
A landscaping and design company, right, we probably wouldn't want to take a 3-month measurement period from May, June, and July. That wouldn't, that might not be good. We're going to get very high hours. You might want to spread it out. So a lot of it is,
you probably also don't want November, December, January.
Right. So a lot of it is looking at your workforce and understanding what the law requires and seeing how that applies to your business, and what's the best way to apply that.
I think everybody listening in the last 15 minutes can appreciate how complex it could be to determine which groups that you must provide benefits for. As black and white as the law may be. Two other concepts, though. the insurance the health insurance that you offer, not necessarily provide, that you offer, because people can decline it. It must be affordable and provide minimum value. Two different legal concepts. Could you take us through those?
Yeah, absolutely. And we'll mention, right, that failure to offer affordable or minimum value can result in a penalty, right?
Yeah.
So affordable is this is a key requirement of the Affordable Care Act, right? That the coverage be considered affordable for the employees. Now, unfortunately for employers, it's not necessarily looking for it to be affordable to you, right? It would be great if that's the way the law looked at it, but we're talking about affordability for the employees. So for this test, we're really just looking at the employees' cost of enrolling in the least expensive coverage by the employer that also provides minimum value. And so, what that means right now, a plan is affordable if contributions by the employee do not exceed a certain percent of their household income. So that this year it is 9.12%. And so, right, obviously, employers, we do not know any employee's household income, right? We know what we pay an employee. We don't know what other compensation they get. We don't know what other compensation other family members bring in from that. Right. So basically, what the Affordable Care Act does is it gives companies 3 different safe harbors to choose from, and one is the federal poverty level safe harbor, where you're going to multiply that affordability threshold, the 9.12%, by the federal poverty level. And basically, you're going to get a monthly amount, and the employee's premiums can't be more than that amount. Typically, the federal poverty level is going to give us the lowest number. So it's generally not the best safe harbor to use, because the lowest number means the lowest amount that you can require employees to contribute. The next safe harbor, the rate of pay safe harbor. So pretty self-explanatory, right? It uses the employee's rate of pay or monthly salary to determine affordability. This safe harbor will give you a higher number than the federal poverty level, most likely. But it's generally not good for companies that have a population of employees that have widely varying rates, right? Because, it's going to change what affordability is. So, again, you can look at how these work. For employees who work a lot of overtime, right? You have a lot of hourly employees who work overtime. The rate of pay harbor might not be the best, because it doesn't necessarily look at the overtime, comp. So again, that can be an issue. And again, Mike, any of these could be a half an hour deep dive, right?
Right.
So I'm just trying to really touch it so that what you should be looking at. And the last one is the wages, the W-2 wages safe harbor, which uses the employee's W-2, the box 1 on the W-2 form, and you can't make them pay more than 9.12% of that.
What's the most common safe harbor that people use?
So I think W-2 is probably a pretty good one that many use, because especially for employers in industries where employees work generally, the same amount of hours, week to week, the W-2 safe harbor can be a good one. So, but yeah, usually it's going to be the W-2 or the rate of pay.
And just doing the math, I mean, this isn't insignificant. This isn't like some just big catch-all number. I mean, if you're 9%, I'll just, for easy math, I'll round it up to roughly 10%, right? if you have an employee making $100,000 a year, that's a decent job, right? And
Yeah.
you can raise a family on that. But 10% of that, 9% of that is $9,000 a year. I mean, $9,000 a year doesn't buy the top of line insurance, right? I mean, if you're making 50,000 a year, if you're making 40, so let's say, I know it hasn't taken effect yet, but the new minimum exempt salary is going to be what, 52, 53,000. I mean, you're not buying phenomenal insurance for, call it $4,000 a year, 9% of 53,000, right?
And look, not to mention, right, you calculated what this could mean, how much, this means for one employee, right? And if you're an ALE, minimally, you have 50 employees, if not many more, that you're paying, for their insurance. So,
and I guess so like I'm used to insurance costs personally for family, which is obviously much more expensive. This 9.1% is for single coverage just for them, probably, right?
Right. So self only, right? That's the test, right?
That makes way more sense. I'm like, the math ain't mathing for me otherwise.
Yeah. Right. So if they end up getting the coverage for dependent, right, all that, right, you're still going to be bound by that 9 point something percent, but right, the dollar amount is going to be bigger. But right, that's why you measure it up against that self only coverage, and you're looking at the least expensive self only coverage.
So I'm gonna accelerate this for time here, but so we talked about whether you are an ALE or not, and then if you are, what makes FTE classification for whom you must offer it. It's got there's 3 safe harbors for the affordable component requirement, 9.1% roughly. So it's either federal poverty level, rate of pay, or W-2 wages. Those are your 3 options. The last component is minimum value. How do you determine minimum value?
Right. So minimum value really it's a standard for measuring the plans to make sure they provide at least a certain minimum amount of coverage. And so I don't want to dig into this too much, but what often happens is that if you're getting a metallic tier plan, right, those will meet minimum value. So I believe, right, bronze plans cover, I believe, like 60% of average in-network medical costs. I think silver is 10% more at 70, gold 80%, platinum 90%, right? Any of those are going to meet minimum value. So
right, Brian, is it safe to say that this is probably the most complex area, maybe too deep a water to even attempt for the average small employer, that this is what you really need to rely on your benefit broker to consult and advise and make sure that you are offering compliant plans?
Absolutely. And so I think what employers need to know enough of is to ask the question and make sure that they are offering plans with minimum value, right? Because you don't want to be sent by pushed by a broker, somewhere else. So, you just want to make sure that you're asking that. But right, the determination of what minimum value is, you can typically rely on your, benefits, broker, provider to ensure that that's being met.
All right. So, final question: you got 2 minutes to answer what could be an hour-long podcast. What bad thing happens if you don't do all this stuff right? What are the penalties? What are the consequences?
Sure. So there are 2 different penalties, really, that we're looking at. There's one penalty. It's called the 4980H penalty. And that's the big one, right? That Section A, right? That's where, employers are subject to penalties if they fail to offer 95% of full-time employees that chance to enroll in, a plan that has, minimum essential coverage, right? or, so basically, if you don't do that, if you're not offering that type of plan to 95% of your full-time employees, there is a big, big penalty, right? This is what essentially happens is, for this year, I believe it's almost $3,000 per year, about 200, a little less than 250 per month per employee. And this is triggered if you fail to offer that minimum essential coverage to 95% of those full-time employees.
And is the $3,000 per year per employee of just the FTEs that you should have offered it to, or all employees?
Right. Yeah. So that's so right. So exactly. If you're an organization with 100 employees, and then you'll be charged against against those 100 full-time employee count, and under this penalty they take off 30 employees off the bat. So you get go from 100 to 70, but then it's that almost $3,000 penalty multiplied by those 70 employees. So because it's applied on that per capita basis for every full-time employee of the large employer, it's a killer, right? Because all that you had to do is not offer it to, this coverage to 95%. So you may have offered it to 90%. So many of these people you're penalized for, you may have offered coverage to, but you're getting penalized for every single full-time employee, regardless of whether you offered coverage, because you didn't offer it to at least 95% of your full-time employees.
Right. And I'm going to see if I know we're at time, so I'm going to see if I can recap this whole thing, and I'll give you a final word. All right. So the Affordable Care Act, if you have more than 50 employees through the FTE hours worked calculation, so you could have 100 part-timers working 20 hours a week, and that puts you over the calculation. So that's got one type of FTE calculation. But if you're more than 50 employees, with an exemption just for some seasonal work, we talked a little bit about that, then you are considered an ALE, an applicable large employer. If you are an applicable large employer, an ALE, then you must offer benefits to at least 95% of your full-time equivalents using a different calculation, not the same calculation to determine if you're an ALE. And those benefits that you offer, they must meet an affordability test. We talked about the safe harbors for that, and must provide a minimum value test. Our guidance here: work with a reputable insurance broker who can help you ensure that you're choosing compliant plans, compliant offerings. And if you don't do this, the fines are very steep. $3,000 per year per employee. Maybe carve out 30% or 30 employees. I wasn't sure what you said there, but just think about $3,000 a head. This is going to be damned expensive if you don't comply. So this thing has a lot of teeth into it. It's a super serious law. You know what? When it first passed, it passed with tons of controversy, some for, some against. The reality is this is a popular law from employees' perspectives. Employers, doesn't matter whether you like it or not, you got to comply. And I think people are generally over it and accept it as law of the land now. So arm yourself with as much information as possible so you can comply as hassle-free as possible. Brian, I'll give you the last word.
Yeah, no, look, I think you summed it up well. I think, look, as an employer, whether you're below or above this, understand this is your responsibility. You can't 100% rely, on a broker or benefits provider. You need to have some, understanding of what this law requires of your organization, and based on size and other factors where you fit into it. And yeah, I'd say that's the most important part: determining whether you're you're going to be required to make insurance offerings based on this law. And then I think, Michael, a last point for small employers: don't think that just because you're small and maybe nowhere close to 50 yet, that you should ignore this topic in total. Because if your competitors are over 50, right, and they are ALEs, then they're offering a huge benefit that your company isn't. So even
Yeah.
small employers, look into this area, consider it, because it's a benefit that many companies are required to and do offer, which can certainly make them more competitive in the workplace.
I know I told you I was going to give you the last word. I'm going to steal it back from you. I think you just hit the nail on the head. Going back to the 2008 presidential election cycle, the 2010 when this ACA became law, there was a cost of health care and how to bend the cost curve. That's unfortunately that hasn't materialized. But there's also just the humanity of it and making sure there were fewer people that weren't covered by insurance, right? Today, a lot's changed in 14 years. Based on birth rates 20, 30, 40 years ago, we talk about this all the time, the available workforce is flattening, right? The 2020, we think about the momentous year of COVID. There was another really, really big thing happening in 2020 that was buried in the headlines. More people over working age 65 than under 65. That's the first time in U.S. history. We have an aging population. We have a flattening workforce. And so this 3.7% unemployment rate, this is not the result of COVID or a Ukraine war or presidential politics. This is the result of a growing economy and birth rates 30 and 40 years ago. The available workforce is flattening. In 50 years, the U.S. population is set to start to shrink. The punchline is that the available workforce isn't changing, and the war for talent is a permanent fixture. If you're going to recruit the best talent and retain the best talent, you're probably going to have to provide some type of benefits, even if the law doesn't require it from you. So whereas 14 years ago, the ACA was to try to ensure coverage, I really kind of believe the marketplace is going to take care of this based on supply and demand. And employers, that you're not going to be successful if you're not offering some type of benefits to your employees. So I'll get off my high horse on that one. Brian, thanks. Always enjoy talking to you and learning from you. And to everybody else, if you got value from this conversation today, if you learned something, I encourage you to like, comment, share, and subscribe on whatever platform you choose. Until next time, thanks again, Brian.
Thank you.
That's it for this episode of Mission to Grow. Thanks for joining us today. For show notes and more episodes, visit us at missiontogrow.com. If you found this content valuable, I invite you to share it with a friend and subscribe to the show. If you really want to help, I'd love it if you left a 5-star review on Apple Podcasts, YouTube, or wherever you listen. Mission to Grow is sponsored by Assure. Assure helps more than 100,000 businesses get access to capital, stay compliant, and develop the talent they need to grow. To learn more about how Assure can help your business grow, visit assuresoftware.com. Until next time.